Greetings. Today is Friday, May 3rd, 2024, and this is our monthly market monologue. We're going to talk about the stock market for the month of April, as well as what we see overall. April was obviously a tough month. We'll show you some positive signs and some reasons why we are not yet bearish. Also going to wrap up the video with a video that my son made. A stop motion video that my son made. He calls it The Adventures of Paul, so stay tuned for that. I think you'll find it humorous. That said, for those of you who are not familiar with me and my firm, Hicks Associates Wealth Management serves individuals and families by serving as their chief investment officer, proactively managing their portfolio in a fee-based fiduciary capacity. Our active management approach is designed to minimize drawdowns while capturing upside momentum. We also serve clients by being intimately familiar with their finances so we can guide their decision-making with data-backed advice. If you want to learn more, take a look at our brand new website, Hicks-Associates.com. You can hit the schedule a call or begin here. Either one of those buttons, you'll be able to reach out to us and we'll be happy to schedule a time to chat and tell you a little bit more about us and how we might be able to serve you. And with that said, let's dive in. So on the screen right now is the S&P 500. This is a monthly candle chart, and this right here is the month of April. What we really want to highlight right now is the fact that, yes, April was a tough month, but look what happened right before that. For the prior 5 months, November, December, January, February, March, we had 5 months of a very strong market rally. The fact that we have 1 month where the stock market is taking a breather and consolidating really should not be a surprise. The stock market does not move consistently up. It is going to go up. It is going to come back down. The question that we have to ask ourselves as active portfolio managers and risk managers is simply whether or not the trend has changed. Have we changed from a bull market back into a bear market? So let's take a look at that. First, we're going to look at it from a weekly standpoint. The last 4 or 5 weeks, very tough weeks indeed. In particular, we want to spend a minute on the daily candle chart because April 1st is right here. So as soon as April started, we started experiencing some pressure in the overall stock market. Again, that follows 5 months of strong stock market performance. However, that correction within the month of April was really only about 5.5%. And the message that we want to try to convey is a 5% correction within the confines of a bull market is incredibly common. So now that we've taken a look at the correction in the S&P 500, the traditional cap-weighted S&P 500, let's look at the same correction on the same 500 stocks, but this time look at the equal weight calculation. This is now the equal weight S&P 500. The ticker symbol is RSP. We can see that the correction was just a little bit worse. But in particular, what I want to show you is something that's very, very common in technical analysis, is very common stock market behavior. This correction in the equal weight 500 was stopped, was arrested, if you will, at this level, this gray area zone that I've drawn in. This acted as support. Previously, it was acting as resistance. So as the S&P, the equal weight was coming up in November, October, December, and the beginning of the year, the S&P, the equal weight version, was having a hard time breaking through this level. So when this correction in April started, where did it stop? It stopped right at that prior support level. That is very common behavior in the stock market and is actually a very encouraging sign because this area is what we call a natural support area. So we know that the month of April 2024 was a pretty tough month with about a 5% correction. How bad was it? Well, on the screen right now, we have our seasonality chart, which is showing the monthly performance on average since 1950 for the S&P 500. And you can see that historically, on average, April is a pretty good month. However, this year, not the case. If we flip the script and look at the S&P Small Cap 600 Index, again, we see traditionally April is a pretty positive month. Simply not the case this year. So let's take a quick look at our vertical speed indicator. Reminder, this is the composite indicator that we put together ourselves. It's comprised of 14 different individual indicators that we roll up into one indicator in an attempt to have a weight of the evidence approach. If you want to learn more about the VSI, there is a video on our YouTube channel describing this in a little bit greater detail. So The bottom pane is the VSI indicator. It is showing us that at the beginning of the month of April, all 14 of our indicators, the individual components, all 14 of them were pointing to a risk-on environment. Where did we end up for the month? Well, at the end of the month of April, that has backed off to about 50%. So now we're in that no man's land between where we would argue risk on and risk off. But our VSI has not flipped to a sell signal. As a reminder, we do have two different quant models. On the screen right now is the majority of the models that we put together for our clients. And each one of these colors represents a different model. And so you can think of it the way that we manage money is that we're managing a model of models. And each one of these models has different sets of rules. This is part of how we approach and how we implement what we call a multi-strategy investment approach. The reality is there's no such thing as an investment strategy that works 100% of the time. And so we put together multiple different strategies. You're no doubt familiar with the concept of diversification. Typically, diversification is referring to where your assets are allocated, like large cap, mid cap, small cap, international, etc. In our case, what we're doing is, for the most part, is we're diversifying our strategies. The idea being that if one strategy is not working, we have another strategy that is. Again, there's no such thing as an investment strategy that works 100% of the time. Again, so each one of the colors on the screen represents a different model with a different set of rules. In particular, I want to highlight the purple and the light blue. These are what we refer to as quant models. A quant model is a rules-based approach. It is an if-then. If this, then we do that. It's a very simple approach. That's what a quant model is in a nutshell. And so we have two different quant models that we put into our models. And our VSI quant model, as I just mentioned, did not flip to a sell signal. However, our dual momentum model did raise some cash in the middle of the month. And again, that is done by design. We have two different quant models that have two different sets of rules, and they take a risk on and a risk off approach at slightly different times. Again, that's done intentionally. So whenever we have a tough month in the markets, invariably some people ask, should we be moving to cash? That's the title of the screen, and that's why I walked through the two different quant models, the VSI quant model and what we call the dual momentum quant model. They raise cash differently based upon predefined rules that the quant models adhere to. But bigger picture, should we just move to cash because, hey, the bull market is over and we're just going to go right back into a bear market? Well, we don't think that is appropriate. We do not believe at the moment that we are going right back into a bear market. So let's take a look at one of the reasons why I say that. Right now we have the S&P 500 on the screen. This is a monthly candle chart. The red line represents a 10-month moving average. The bottom pane is just showing you graphically how far above or below the S&P 500 is in relation to that 10-month moving average. And this is one of the charts that we look at that we would say we do not believe that the long-term bull market trend has changed. And we say that because we're still above this 10-month moving average. However, let's play devil's advocate for just a minute and say, well, what if this next month, the month of May, let's say it's also tough and maybe we do dip below that 10-month moving average? Well, that by itself doesn't dictate that we just move to cash. This is, again, why we use a weight of the evidence approach, and it's also why we have different models that have different sets of rules. But let's take a look briefly at an example after the dot-com crisis. We're going to look at this period right here. And you can see, again, this is 2000. We have the dot-com crisis where there, 2 or 3 years where the S&P 500 is below the 10-month moving average. Then coming into 2003, we're finally breaking the trend and we start marching north. And you can imagine going back to that time period where the market starts drifting lower and then we finally dip below that 10-week or 10-month moving average. And so, hey, we should move to cash. Well, we would argue not necessarily, because look what happened right after that. This was a 50% correction, but what we want to highlight is right there, that was a 9% correction. Definitely not fun to go through. But what happened? after that. This is again the same time period that we just looked at, and you can see that had we just gone to cash and then gotten shaken out and scared, we could have very easily missed a multi-year run. So that is one of the reasons why we don't necessarily want to just shift to cash whenever we have a little bit of a pullback. And again, right now, if we look at just this indicator, which is only one, this is telling us that the long-term trend is still intact, and we do not believe that we are shifting back into a bear market. There's just not enough evidence for us to believe that we are shifting back into a bear market. Now, if we switch the screen and we look at the NASDAQ, now we have the NASDAQ, the same indicator on the bottom, we see the same thing. We see this is a correction within the confines of a bull market. We will adhere to our rules. We'll raise cash in the quant models when the quant model rules dictate that we do that, and the sector rotation and the stock model, same thing. We will stick to our rules. One of the things that I mentioned in last week's video where we talked about presidential election years is the fact that from May to November, or May through October, I should say, the S&P 500 on average can generate muted returns. They're positive, but they tend to be a little bit muted. But that doesn't mean that we should expect everything to be muted. So let's take a look at that really quickly. So on the screen right now, we've got several different things. We've got the Magnificent Seven. All this is year to date, by the way. We've got the Magnificent Seven still at the top in terms of year to date, but look at the correction here recently. We'll show you that again in a second. The S&P 500 mid cap, you've got small cap, and then these bottom two are bonds. This is the U.S. aggregate bond ETF. And it's -3, 3.6 year to date. And this is long-term treasuries, TLT. Long-term treasuries, -9.74%. And this is one of the reasons why we have said what we've said about conservative investors. If you are a conservative investor, we may want to discuss adapting or changing how you approach managing risk. Because again, bonds are negative almost 10% year to date. And I suspect we might have a continued challenging environment for bonds, which would be very challenging for conservative investors. But let's switch and let's take a look at just since March 1st. Again, you've got bonds -5, long-term bonds negative almost 6%. Magnificent Seven starting to drop a little bit. That correction was a little bit more magnified, if we can use that term. And then we have mid-cap at the top. So again, that is since March 1st. But one of the things I mentioned in last week's video was the fact that not everything is going to fall in line with this. Not everything is going to be somewhat a muted return. And in last week's video, I referenced that there are some countries, I'll show you one, there are some countries that are exhibiting some very positive momentum. Since March 1st, India is certainly one of those countries. That is just one of many, but that's something for us to be paying attention to, because as a part of our risk management and active management approach, our job is to go out in our sector rotation model in particular, find those areas where we can invest that have positive trends. If the U.S. stock market is in a temporary negative trend, is there something else that we can put in the portfolio that is in a positive trend? India is a simple example. So that'll do it today. We'll wrap up today's video with the video that I mentioned that my son put together. Our son is 10 years old, and he loves cars. And he recently learned how to make stop motion videos. And so this is a stop motion video that he put together. He calls it The Adventures of Paul. No, it's not Paul Richards, but for whatever reason, he calls his little mouse Paul. And I hope you enjoy.